Have you ever wondered if there's a way to create additional leverage and a tax deductible through your mortgage? Well, in today's video, we're going to dive into the financial strategy of the Smith maneuver, which allows you to do just that. The Smith maneuver was popularized in Canada by Fraser Smith, a financial advisor. The strategy revolves around converting non-deductible mortgage interest into tax-deductible investment interest, allowing you to potentially save on taxes while growing your wealth. In today's video, we're going to go over an example of how the Smith maneuver works and some of the pros and cons associated with the strategy. Before we dive in, it's important to note that tax laws vary from country to country, and although this strategy has been popularized in Canada, it is possible to execute a similar strategy in other regions with other assets other than a home. For those new to the channel, welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you're looking to get control of your finances and make smart financial decisions, be sure to like and subscribe to the channel down below. Before going into the pros and cons of the Smith maneuver, it's important to first understand how the strategy actually works. In simple terms, the Smith maneuver is a strategy that focuses on gaining leverage through the equity in your home and then having the ability to write off the interest that is paid on that leverage. Let's take a look at an example. Imagine Nina wants to start utilizing the Smith maneuver. The first step is to ensure that she has a readvantable mortgage. A readvantable mortgage allows individuals to access additional funds the more that they pay down their mortgage. Once Nina has set this up, this will allow her to tap into equity that she has built within her home. For example, imagine that Nina's monthly mortgage payment is $3,500. Of that $3,500, $2,000 is allocated to her interest owed and $1,500 is allocated to her principal. The $1,500 paid towards the principal now represents equity that Nina owns on her home. This is where the readvantable mortgage comes into play. Since Nina has set up a readvantable mortgage, she can then borrow against the equity within her home, meaning Nina can now gain an additional $1,500 in leverage, and as she continues to make monthly payments, she can then borrow additional funds against the equity within her home. The next step with the Smith maneuver is for Nina to then take that additional $1,500 that she has leveraged against the equity in her home and invest in things such as stocks, bonds, mutual funds, or real estate investment trusts. The key piece here is to choose an investment that is aligned with your financial goals, risk tolerance, and time horizon. Once additional capital has been invested, the next step is to deduct the interest paid on the borrowed funds. Let's imagine that over a 2-year period, Nina borrows $36,000 against the equity in her home and pays approximately $2,200 in interest. Nina can then take that $2,200 paid in interest and use it as a tax deduction. That money from her tax deduction can then be put towards an additional payment on her mortgage or other types of investments. The reason this strategy has become so popular within Canada is because people are unable to write off interest on their primary residence. By utilizing the Smith maneuver, Nina has now turned a non-tax deductible interest into a tax deductible one while also gaining leverage, meaning Nina now has additional funds in which she can invest and a tax deduction which she can now claim. However, with this strategy, there's definitely some risks to consider. One of the main ones being that with the Smith maneuver, you're borrowing additional money to invest. As you're investing this money into the market, you're taking on additional inherent risk. For example, let's imagine that Nina decides she will take that money which she has borrowed against the equity in her mortgage and invest in an index fund that tracks the S&P 500. Over the course of the next year, the S&P 500 proceeds to drop by 7%. Meaning that Nina is down on her investment and she still needs to pay the interest on the money that she has loaned. As you can see in this example, there's substantial risk with this strategy if individuals do not plan for the long run and if investments they choose to use do not outperform the interest that they must pay on their loan. To avoid this, it is always recommended to speak with a licensed financial advisor who can tailor a plan to your unique financial situation. When using the Smith maneuver, it is important to look for investment options that have strong historical performance that is greater than the percent you will pay in interest from your loan. For example, if you invest in a fund that has traditionally earned a 7% return and the interest you pay on your loan for this investment is 3%, you will likely come out ahead in the long run, as over an extended period of time, you'll be earning a higher rate of return compared to the interest you owe. As well, with the Smith maneuver, you will also have a tax deductible, helping to put you even further ahead of the interest owed. And lastly, one of the major risks with this Smith maneuver is that you're borrowing against the equity in your home. Meaning, if you find yourself in a situation where you're unable to pay this money back, the bank could potentially foreclose on your home, a situation that nobody wants to find themselves in. All in all, the Smith maneuver offers a unique approach to mortgage and investment optimization. As always, it's important to carefully evaluate the pros and cons, consider the risk involved, and seek professional guidance to determine if the Smith maneuver aligns with your financial goals and risk tolerance. The strategy's potential benefits, such as maximizing tax deductions, accelerating debt repayment, and building wealth through investments, should be weighed against associated risks, including market volatility and interest rate fluctuations. Thank you for watching, and as always, if you found this video to be helpful, please give it a thumbs up and consider subscribing to the channel for more everyday financial and self-improvement topics.